National Income Part 3. Methods of Measurement of National Income. There are three methods of measuring national income. First, output method / product method. Second, income method. And third, expenditure method. Methods of measurement of national income. First, output method. Second, income method. And third, expenditure method. Output method. This method of measuring national income is also known as product method or inventory method. This method approaches national income from the output side. According to this method, the economy is divided into different sectors such as agriculture, mining, manufacturing, small enterprises, commerce, transport, communication and other services. The output or product method is followed either by valuing all the final goods and services produced during a year at their market price or by adding up all the values at each higher stage of production until these products are turned into final products. While using this method, utmost care must be taken to avoid multiple or double counting. To avoid double counting, this method suggests two alternative approaches for the measurement of GNP. First, final goods approach / the final product approach. Final goods are those goods which are ready for final consumption. According to this approach, value of all final goods and services produced in primary, secondary and tertiary sector are included and the value of all intermediate transactions are ignored. Intermediate goods are involved in the process of producing final goods, that is, the final flow of output purchased by consumers. Hence, the value of final output includes the value of intermediate products. For example, the price of bread includes the cost of wheat, making of flour, etc. Wheat and flour are both intermediate goods. Their values are paid up during the process of production. In the final product, which is bread, the value of intermediate goods are already included. Thus, a separate accounting of the value of intermediate goods along with the accounting of the value of final product would mean double counting. To avoid this, the value of only the final product or goods must be computed. Second, value added approach / the value added method. In order to avoid double counting, value added approach is used. According to this approach, the value added at each stage of the production process is included. The difference between the value of final outputs and inputs at each stage of production is called the value added. Thus, GNP is obtained as the sum total of the values added by all the different stages of the production process till the final output is reached in the hands of consumer to meet the final demand. This can be illustrated with the help of the following table. Table number 7.1, Value Added Method. Value added at each stage is calculated by deducting the value of inputs from the value of output produced. The sum total added at different stages make GNP. In the above table, the value of final good shirt is Rs 500. The sum total of value added at each stage of production is Rs 500. Thus, the total value added is equal to the value of final goods, which is 150 plus 100 plus 150 plus 100 is equal to 500. Precautions. While estimating national income by output method, following precautions should be taken. First, to avoid double counting, only the value of final goods and services must be taken into account. Second, goods used for self-consumption by farmers should be estimated by a guesswork. Imputed value of goods produced for self-consumption is included in national income. Third, indirect taxes included in the market prices are to be deducted and subsidies given by the government to certain products should be added for accurate estimation of national income. Fourth, while evaluating output, changes in the price level between different years must be taken into account. Fifth, value of exports should be added and value of imports should be deducted. Sixth, depreciation of capital assets should be deducted. Seventh, sale and purchase of second-hand goods should be ignored as it is not a part of current production. Output method is wisely used in the underdeveloped countries. However, it is less reliable because of the margin of error. In India, this method is applied to agriculture, mining, and manufactures, including handicraft, but it is not applied for transport, commerce, and communication sectors in India. Second, income method. This method of measuring national income is also known as factor cost method. This method estimates national income from the distribution side. According to this method, the income payments received by all citizens of a country in a particular year are added up. That is, income that accrue to all factors of production by way of rents, wages, interest, and profits are all added together. But income received in the form of transfer payments are ignored. The data pertaining to income are obtained from different sources, for instance, from income tax returns, reports, books of account, as well as estimates for small income. GNP can be treated as the sum of factor incomes earned as a result of undertaking economic activity on the part of resource owners and reflected in the production of the total output of goods and services during any given time period. Thus, GNP according to income method is calculated as follows. NI is equal to rent plus wages plus interest plus profit plus mixed income plus net export plus net receipts from abroad. Ni is equal to R plus W plus I plus P plus Mi plus X minus M plus R minus P.